welcome to the Capital Discussions kickoff for Amy's trade alerts, the Weirdor strategy. So I've got myself, Jim Riggio, and Amy with me, but before we get started, go through a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you want to read it in its entirety. So with that, Amy, I will pass the ball back to you.
Okay.
And welcome. We're excited to have your service finally starting. This is a historic day for us.
Oh, great. Yeah, me too. Actually, I was planning on hoping actually to try to get this rolled out January 1, make it a nice, easy rollout, beginning of the year, start a new year fresh and all that. But with the holidays and scrambling around to try to get everything done, I just felt it was I didn't want to make it too rushed. I wanted to make sure that I was putting something together that would be beneficial to everyone and all of your members and anybody else who wants to join. And so I think, taking the extra time to do that was well worth it. And I appreciate everyone who has been, patiently waiting for this to start. And I think you'll be well rewarded as far as me taking some extra time to make sure that I'm going to give you hopefully a lot of information and some useful knowledge and so forth about this particular trade strategy and how I trade it. So you'll be basically watching, what I'm doing. So basically what I'd like to do is this is like kind of the official, webinar of the start of the class. And because it's kind of going over, I'm going to basically be going over what's included in the subscription, an overview of the Weirdor strategy, and also what the trade alerts are going to look like, so you know what you're going to be getting on your text or SMS messages or on the emails that are going to be coming out, so you have an idea of how to read those. When we're going to actually, when to expect the first trades to come through, and have a Q&A session as well. So what I was trying to do was on that WebEx that we had last week, was trying to get to that after, I think I had gone through, I don't know how many of you have watched that, the last couple of WebExes I did on the Weirdor, but I basically went through my last Weirdor trade, and I was hoping to kind of get to all of this then, but ran out of time, and I didn't want to just, skim over everything. So I felt like, let's kick this thing off right, give you all the information that I just mentioned and open it up to all the members because it's basically an overview also of subscription to see if anybody else is interested, since I didn't get to go through everything in detail last week. So with that, I'm going to get started. And I did get some questions via the Ask a Question tab on the class page. So thank you for those of you who, I don't know if you were able to make it, but thanks for submitting those questions, and those will be answered as well. If you're not here live, I will be answering those as well. So towards the end of the session, if not in the middle, if it's corresponding to what I'm talking about at the time. So let me get started here. Let's see. I'm going to share my desktop. And the first thing I'm going to talk about is what's included in the subscription. So a little cheat sheet here. So basically, this is a trade alert. So it's not really a class like big, intense workshop on the Weirdor trade and trying to give you every single scenario that or not every single scenario, but trying to give you as much packed in to, like, let's say a 5 to 8 week session of how to trade in all different markets this particular strategy. This is just obviously, as the name implies, a trade alert service. So you're going to be getting, as I'm trading this in a Reg T account, you're going to be getting the actual trade alerts as I'm trading it. So if I'm, entering the trade or making adjustments or exiting the trade, you will be getting these SMS text alerts or email alerts or both, depending on your choice in the subscription, if you want to receive both or just one of those. And as I make them. So it will be basically real time. I mean, very slight delay as far as soon as they're filled, I'm going to be sending those out to you, and you can see exactly what prices I got, what stripes I chose, and so forth. So you can really kind of follow me along as I do this, and hopefully really get a better understanding of how I trade this particular strategy, and hopefully learn a lot about that. So one other thing I'm going to talk about today that I forgot to mention is I'm also going to navigate through the class page. So that way, show you how to navigate through there and what's going to be included on the class page and how to use it and so forth. So I'm going to do that as well. So the first thing I'm going to talk about is what's included. So basically, you're going to get an overview video of the trade, the basic setup, adjustments, and exit strategy, which I will go over a bit today as well. But in the class page, there's also a separate video specific for that. You are going to get real-time trade signals for the Weirdor for each monthly expiration cycle. This is the trade that I do for every monthly expiration cycle. I've dabbled with the weeklies, but generally I like to just do the monthly expiration, and so this trade alerts will be done on every monthly expiration cycle for the Russell, and this is also going to be for the Russell 2000 index. As of now, that's the only index that this is going to be trade signaling for. And I generally only have one trade on, or one position on, I should say, for at a time. So I kind of almost, sometimes I overlap by a few days, but I want to make this something that, if I had or what I'm starting out with here is just a $20,000 Reg T account, where so in order to benefit or to use as much of that margin as possible, that's what I'm going to need for a single tranche Russell 2000 Weirdor. The margin it'll use is about $18,000, so I have a couple $1,000 buffer there, so about a $20,000 account. And I will talk about a little later on scaling up or scaling down. But for now, that's the basic what I'll be starting with, that's what the trade signals will be about. So basically, because I'm limiting myself to that much in the account, I'm only going to be putting on one position per monthly cycle. So I won't overlap like some of you might know about my nested iron condor, which is, I go into that with many more days to expiration, so I kind of have to overlap and have enough in my margin to handle 2 trades at a time in 2 different monthly expiration cycles. This one's going to be kind of just stick with one expiration cycle at a time, one position at a time. When one of them is closed, I will put the next one on. So it's going to be something that will be easier to follow in that respect and easier on the margin. So with that, though, there occasionally may be 2 or more trades that are made per month, and this happens generally if the market is moving in one direction from the beginning of the trade quite a bit to the point where I want to just take it off and then reposition the whole position. So occasionally there might be 2 positions on during a month, but not at the same time. But that's happened before. Like for instance, if the market is really screaming up higher, and I'm, this particular trade, and you'll see this. Get out of there. You'll see this hopefully, during the time of this class or service, where I'm actually able to take a profit, a small profit, if something like that happens, because I'm not defending the call side as much, and able to then reposition the whole trade to different strikes and then make a profit on that one as well. So that happens occasionally. So occasionally there might be 2 or more trades made in the same expiration month, but at different times, just repositioned. And each trade alert will be sent out via SMS and email, and will include all trades for each position. So the entry, any adjustment I make, and the exit. So completely, you'll see everything that I'm doing. Did anybody lose sound? I'm going to just go to the chat box here. Let's see, no, I just want to double check before I continue. Okay. And okay.
No, we're all good on this side, Amy.
Okay, good. I just want to make sure. I just saw that little message pop up, and I just want to make sure that's happened before sound is cut out, and all of a sudden I'm chatting away for 5-10 minutes, and I don't realize that. So hopefully whoever that was, John, gets his sound back up quickly. In addition to that, so the trade signals, obviously, there will be weekly videos to recap where the trade is at the end of each week and what to look for in the week to come. So these are just going to be little recordings that I make, probably like maybe 5-minute little short videos that I'm just going to make. It's not going to be a WebEx that you can log into, but it will show up in the subscription class page under the library, and they will be little weekly video recaps of where the trade is at, or whatever position I happen to be in that week, where it's at, what it looks like, what kind of recap what happened, because you'll be getting, if there's any trade signals that go out that week, you'll be getting those, but I'll make a little more explanation of why I did those things and so forth. And those will, again, be recorded and available in the library at the end of each week. Sometime by Sunday night, they should be there, certainly by Monday morning, but anytime between Friday night and early Monday morning, those will be available for you to view. So hopefully, I'm going to try to get it so that you're actually getting them on the weekend and not waiting until Monday morning, though. And then additionally, I will be doing a live WebEx that you will be able to join. And at the completion of every trade. So every monthly expiration cycle, I'll be entering a trade, I'll be making adjustments, and I'll be exiting a trade. And once that trade is exited, which will be generally anywhere from 30 to 45 days is the length of these trades that are put on at the most. So generally, so almost monthly. Just depends on exactly when that completion of the trade is. I will be sending out a message saying, hey, this trade has been exited. You'll have all the exit trade alerts, of course, that will have come out to you prior to that. And it's time to, go online and join me for a live WebEx to go over that trade in detail from beginning to end. And I will go over that and, talk a little bit more about anything that was maybe a little, different that month, or things, that I was looking at. And, of course, a lot of that stuff is going to be gone over in those little weekly recaps. But this will allow you guys to log on with me and have like a question and answer session. And again, you'll be able to ask questions before that throughout the week that I will include in the weekly video recaps, and also answer them in this monthly WebEx if you guys aren't able to join live. So that's all that will be included in the subscription for now. And again, this is for the Russell 2000 Index Weirdor, and it will be a single tranche Weirdor, which I will explain in a little while, in a $20,000 Reg T account. Okay, so with that, I'm going to go through and kind of navigate the class page so that you can see where you're going to find all this information and what to look for. So I'm going to go here to Capital Discussions and log in. Close that little window for now so you guys can see everything. And I'm going to go to the, so basically from the members website that you guys all logged into, there's a classes tab at the top here. And as most of you probably already know, if you click on that, it'll show what classes are available. If you're already a subscriber, then you'll be able to click on the Amy Meissner's Trade Alerts, the Weirdor strategy. And if you're not a subscriber, then I would imagine this some kind of a little thing that you click on will take you to a page that you can sign up as a subscriber, where there's a 15-day free trial period to check it out.
Yeah, I just put that in the chat.
Okay. And then I'm going to click on that, and that will take me to the class page. So what's available here, and there's also, by the way, I've done a couple of introductory videos. I'll talk about that in a second. But so I'm just basically going to take you through navigating through the class page and what you're going to see or what may or may not be there for you to go through. The first thing I'm going to talk about is this little header up here. this is an area that may or may not show up depending on what's going on. It's just set up so that if I have a specific announcement or a reminder or something like that, I can actually create these announcements or reminders, and they will show up at the top of the class page. Like, for instance, here I have a reminder saying, hey, there's a live WebEx today, and to introduce a service and what I'm going to be covering. There might be something else that says, hey, we're getting ready to enter a trade, or getting ready to exit a trade, or maybe something that's going on that I think is important. And then, of course, announcements of the WebExes and so forth. So there may or may not be an announcement at the top, but if there is, this is what it would be. And anytime you go to the class page, you'll see that there. In addition to that, there are a number of tabs that are available for you to go through. And here it only shows 4 tabs, but there's actually a couple of others that aren't being displayed here because there isn't any information in them as of today, but they will show up as information gets posted. So the first tab is the library tab, and this is very similar to the library of the member site, where it'll list all of the videos that are associated with this particular service subscription class. So, and this is where you will see the little weekly recap short videos, as well as the recorded WebEx videos that I do upon completion of a trade. So, and in addition to that, anything else that I might feel like I want to share with you guys with the video format, I will put here. So, as you can see, I've already posted a couple of getting started videos. I'm going to be going over most of that stuff today, but if you missed anything or have any other questions, or I didn't get through all the detail of that, you can go through and watch those 2 getting started videos. If there's any documents associated with the videos, they will also appear underneath, very similar to the way the library tab. So if you go to the library, you'll see, there's audio file, a video file. Sometimes there are documents associated with, I don't see it here, but you guys are familiar with member site, so it would be very similar to this. If there was any additional documents associated with a WebEx recording, they would be here. And if not, then it will just appear as it does with these, where you have the description of what it is, and then you can click on it and watch that video. And then, of course, you have the ability to have a start and end date, which defaults to today's date, and how many records you want to see. And then you can refresh that and have as many. I think it's set to 50 as the smallest, because for refresh purposes or so forth, but I believe it goes up to 500 or as low as 10. So, so that's the library tab. And if there's any questions on that kind of stuff, Tom, you can pipe in and let me know. Otherwise, I will continue. Then there is the Documents tab. And under the Documents tab, these are just documents that I may post from time to time that I might want you to read or have some information about that aren't necessarily associated with a specific video. They're just kind of standalone documents. So as you can see here, I've already posted 3 small documents, just one that's giving you guys a quick background about myself, and another document that talks about the service and what you get with your subscription, which is what I'm going over in this video, and a recent track record of my trade that goes back, I believe, to November of last year or something like that. Not last year, I should say. Goes back. I'll go through that. You would just click on the download for those. And of course, I have a Mac, so I work a little differently on a PC. And then you could open up the document. So this is my recent track record with this particular trade in a Reg T account. And I've been trading this for as a portfolio margin account and a Reg T account. And because this class pretty much is going through a small Reg T account type of Weirdor, which is a little bit different than the portfolio margin one. I can do a few different things, and I have to deal with margin a little bit differently with the portfolio margin. I wanted to show you what was obviously, apples to apples. So this was from November 2013 and this is by expiration month, to January 2015, so it's very recent. I'm still in the February 2015 trade in my live Reg T account, so that will be actually removed probably by the end of this week, and then I can show my result from that as well. So it's very up to date. And there was, I'm just going to go over this real quick because there was one question from someone that asked, do these profit and loss percentage results, are they, let me just make sure I'm reading this question right, I'm going to grab that. Somebody asked me, do the returns include commissions? Yes, they do include commissions. Of course, everybody's commissions are different. The commissions in this particular accounts that I've listed here were in Thinkorswim, and I was being charged $1 per contract. And then as far as are they based on return on risk? And yes, they are. So basically, these percentages are based on the actual maximum risk I had in the trade, which was my maximum margin at any one time, which is approximately about $18,000, you know, a few $100, give or take kind of thing. Once I put on a trade, the margin doesn't really change much for this particular type of trade. So yes, it is based on return on risk. Great, thank you. No problem, Chuck. Thanks for posting that. Okay, so I'm going to close that. Are they based on real trading or simulated? This is a track record of real live trading, you know, live account with real money on a Thinkorswim platform with Reg T account. And now this particular, some of these were 2 tranche, some of them were 4 tranche. I think possibly the November 13 could have been a single tranche, but they were, most of them were multiple tranche, Weirdor trades in a Reg T account. And because of one thing I did want to mention, and you know, don't want to be misleading at all, and I've said this a few times and also posted on the description of the class and so forth, is that for purposes of learning, I decided that, you know, when I'm doing a multi-tranche trade, I might scale in over time, use different strikes. Different things happen depending on, you know, maybe one month I scale in, another month I put it all on at once. It's harder to follow and learn what I'm doing with this strategy if I'm doing a multi-tranche trade. Not to say it can't be scaled up, but the way I trade it live is I might scale into it over time, as well. So that kind of changes the dynamics of it and my adjustments and so forth as well. And it's a little, you know, probably be a bit much as a, you know, to begin to learn how to handle this particular strategy. So what I decided to do is say, okay, well, in order, because this is for, you know, educational purposes and so forth, even though it's real, I'm going to do just a single tranche Weirdor. And because I don't have another Reg T account to open up and throw $20,000 in, I'm not going to split up my other accounts. I'm going to do that. The particular trade I'm going to do is going to be in a paper trading account, but it's going to be real time in Thinkorswim with slippage, with commission, emulating my live trades. So there really shouldn't be any difference other than it's a single tranche instead of a multi-tranche. So if I had a live trade where I was doing a multi-tranche and I scaled in over time, it might be a little bit different. There might be a couple strikes different, but it should give very similar results. And I just think it's going to be a lot easier than getting a whole bunch of, you know, when I say I'm entering a trade, you're going to see the whole trade going on, all 4 pieces that same day, as opposed to, yeah, I put in, you know, part of it, and then maybe a few days later I put in another part, and then you got to kind of keep track of which one am I adjusting, and it just makes it easier for educational purposes. So I just want to be clear about that. But these results are definitely from live trading. And that is what I, you know, will definitely be emulating as well. So where am I here? Okay, so I already went over that. Let's go to, here we go, back to this. So, so again, you can download these documents that are there. Another tab on this page is the Ask a Question tab. And the Ask a Question is available. Just put in subject, ask a question. It's not there for any support questions. So if there's any technical issues like, this isn't working or something like that, please send those questions directly to Tom so you get answered as soon as possible and fixed as soon as possible. And that would be at support@capitaldiscussions.com. Is that correct, Tom?
Yes, that's correct, and I put that in the chat.
Okay. So
I'll also add it on the bottom of that page, too.
Okay, so those will be for support questions. But if there's a question on the specific position or trade that I'm working on at the moment, that's what this is for. So if I, let's say I start the March, which is I'm getting ready to start any day now, the March 2015 expiration trade, that's what this will be used for. So while I'm in that trade, ask me any questions about that particular trade, what's going on, maybe why I made the adjustment, and so forth. If I don't answer right away, they will all be covered in the recap videos at the end of each week, and also in the completion, the WebEx, where you can ask questions. And when I'm going over the whole trade from start to finish. So that's what these questions post those types of questions here, and those will be included in those recordings and in the WebEx as well. In addition, there's also a notifications tab, and in there, this is basically saying that for me, I'm currently receiving email trade messages, and I'm currently receiving text messages or SMS trade messages. So these are for trade messages. For just general class stuff, I'm going to be sending out emails occasionally, just in general for the class. These notifications are set to turn on and turn off the trade messages, so when I send trade alerts. So for instance, if you're on a vacation, maybe you don't want to get a bunch of text messages, you can turn it off, and when you come back from vacation, you can turn it back on. And you can see here I've got both of them turned on. Or maybe you only like getting them via email and not by text, or vice versa, so you can turn one off and turn one on, that kind of thing. So that's what that's used for. In addition to that, I'm sorry?
Just real quick, one point, if you want to get the trade messages via SMS, you have to have your mobile phone number filled in on your profile.
I'm going to go there right now, actually. So for instance, in my profile, so the mobile phone number is where you're going to enter if you want an SMS text. It'll send it to that particular phone number, and you'll put in the area code and phone number. And Tom, you mentioned that if you're in the United States, you do not need to put a +1 in front of that. You just put area code and the phone number. Same with Canada, just area code and number. But if you're outside of the United States and Canada, you will need to use the country code. So it'll be plus whatever the country code is, and then the rest of the number. So for instance, Germany, I believe, is +49, and then a space, and then the rest of the number. Same thing with the other countries. Is that correct, Tom?
That's perfect, yep.
And I see some questions coming through, and I'm going to get to those definitely. I don't want anybody to think I'm ignoring those. And then, of course, for the emails, whether they're specific to the class or the trade alerts via email, that'll be using the top email address here as opposed to the email too, and that you'll do in the profile. So back to the class page. There are two other tabs that will appear that do not appear now because there's no information in those tabs. And the first of those tabs that you will see as well, and they do show up in these getting started videos, is the calendar tab, and that will show up for WebExes that are scheduled. For instance, this completion of trade. I'm going to do a live WebEx, and those will show up for WebExes that are specific just to the people in the class. So you'll be able to see a calendar event for a subscribers-only calendar event in a calendar tab, very similar to the calendar tab in the Capitals Discussions member website, as well as, because you're a subscriber, it will also show up in the regular calendar tab up here, but you'll also have one down here. And then there's, of course, the final tab that's not showing here, but will show up very shortly, is the Trade Alerts tab. And that will list the trades as, by date, and it'll be by, I think in chronological order, newest on top. So basically, as you get trade alerts, to your phone and to your email. They will also be posted on in the Trade Alerts tab, so you can see, they'll go back to, whenever the class started, you'll be able to go back and see Trade Alerts on that page too if for some reason you were on vacation and you turned it off on your phone, or you lost track and you want to see what happened. Those will always be recorded, and I believe that happens concurrently as I'm sending out those SMS and email Trade Alerts, Tom. That happens immediately after I send those out. They go to the Trade tab, correct?
Yes.
Okay, great. So that's the class page, is what you'll see there. So let me continue on. And so now what I'm going to do is I'm going to go through the Weirdor strategy. And again, you can go to the Getting Started video. Tom, there's some background noise. You want to mute your...
Oh, I am muted. I think that's probably Jim.
Oh, Jim. Okay. Okay, so there's also a Getting Started 2 video that I have here that goes over the Weirdor strategy and the makeup of it, what it is, a little bit more about it. But I'm going to do that right now as well, but it's also here in detail as well. So I'll try to get through as much of that as possible. So I'm going to go to here and, well, it's just part of the slide, the disclaimers. It's basically the same other than I too am not a broker-dealer or licensed financial advisor, so but we already went through the disclaimer. Basically, the Weirdor trade is a variant of the Condor. So where it kind of came about was that it's a high probability trade, and it is I should say, the high probability iron condor, which everybody, most of you I'm sure are familiar with, is a great trade. But one of the things that was kind of recognized is that most of the time, the markets, whether it's the Russell 2000 or any of the other markets, they kind of go up most of the time. 75% of the time. I actually did some statistics over the years as I've been trading iron condors and so forth in these high probability trades. What I'm noticing is that most of the time the market goes up, and it's been about 3/4 of the time, or 75% of the time, I'm making call adjustments and not put adjustments. Not that put adjustments aren't things to be worried about. You don't want to just ignore the put side, especially the risk on the put side, because that can be very quick and swift and so forth. But you don't want to ignore the what's going on the call side either. And because these are neutral trades, non-directional, there are more times than, or so 75% of the time, I'm making call adjustments on these. So this trade kind of came about with that in mind and thinking, well, I don't want to defend my calls as much or be hurt by my calls as much if it's happening most of the time. So how can I create a trade that deals with this, but still gives me plenty of protection on the put side and a nice profit? And actually, I'm sure a lot of you guys are familiar with Dan Harvey, a good friend of mine. I hope he doesn't mind me mentioning him here. I'm sure he doesn't. He's actually, as far as I know, the person that kind of originated this because of those. And so I've kind of taken his version and over time have created little tweaks here and there and kind of made a version of it that I feel comfortable with trading my trading style. So that's kind of where this came from. And so why I like it and why I think it's a preferred trading strategy is it's got relatively smooth trade with easy adjustments. Granted, there are more adjustments and a little more trader's choice in this than there are in my nested iron condor, but it's also relatively smooth as long as you stay on top of as long as I stay on top of the trade adjustments. And it's not like difficult types of adjustments, so I like that. It has a high probability of wins, which is what I like to trade. I like to trade high probability option strategies, and this is one of them. It's got about an 80% or higher win rate. It's lower sensitivity to volatility than a conventional condor. So as volatility spikes, Yes, it affects the trade, but it doesn't affect it as much as a conventional condor would be affected by it. Again, as I just talked about, it has minimal upside risk because of this, known or thing that we've realized over time is that we're mostly having to adjust on the upside. And the downside risk is generally pretty easy to manage using additional debit spreads and so forth. So, okay, I'm sorry. So that's kind of why I like it. And there's 4 main parts to a Weirdor.
Amy, before you start that, I just wanted to throw in here that Dan Harvey and I talked about on the previous slide the characteristics of the Weirdor with the low losses. It has a very smooth equity growth curve, which is exactly what you're looking for.
Exactly. Your growth curve going, well, I'm not drawing on here, but if you can see my cursor, hopefully going from the lower left corner to the upper right corner as you're, as I'm making money with this, I'm not having a lot of bumps on the way. It's not, it's very smooth as opposed to choppy with, 1 step forward or 2 steps forward, 1 step back. It's just more smooth than that, than, an iron condor or a conventional iron condor would be. So the 4 main parts of a Weirdor are the put credit spread, or at least the version that I like to do, the put credit spread, put debit spread, the call credit spread, and the additional far out of the money puts. I haven't put that in here, so I'm going to type it in. What I talked about earlier was this particular service is going to do a single tranche, or what I like to call a tranche, you can call it a unit, Russell 2000 Weirdor. And what I mean by that is the ratio of contracts for each of these 4 parts will make a single tranche. So, for instance, in a put credit spread, I'm going to do 10 of those, and 1 put debit spread, 2 call credit spreads, and then 1 single additional far out of the money put. So this ratio of spreads and, in this case, a single put here at the end, is what the combination that I feel is the best for this particular trade as a single tranche trade. As far as scaling up from that, or scaling down for that matter, so if I wanted to put on 2 tranches, I would just multiply each one of these by 2. Or maybe I wanted to put on 5 tranches. Again, multiply each one of these by 5 in that case, and trade accordingly to that. So it's pretty simple as far as scaling up. As far as scaling down is concerned, well, I've been working on this strategy for a couple of years and trading it live in the Russell for over a year. And I've done quite a bit of, I've done some testing on scaling up or down, but mostly I concentrated on scaling up. And so most of my tests have been on scaling up, and that's what I've done. And I feel very confident in doing that, trading it like a single tranche, but just multiplying it. For a Reg T account. As far as scaling down, and this is one of the questions somebody had asked me, I haven't done enough test months to really have a good feeling of consistency with the scaled down version, but there are a couple of ways that it can be scaled down that I can suggest, but I'm not guaranteeing anything, and I wouldn't know consistency because I've only tried it a few times with a few months. One of the scaled down versions of this, which would allow for, instead of a $20,000 Reg T account, would allow for a $10,000 Reg T account using about $7,500 to $8,000 of the margin, would be to change the single tranche from this particular ratio that I'm showing here, and basically cut in half the put credit spread, which of course that would lower the margin, and remove the single out of the money put, and keep the debit spread and the call credit spread the same. And then that way, it could be the same strike prices and basically the same adjustments, but the margin would be cut quite a bit, and of course the profit potential would also be cut, but that would be one way to do it. Another way put this back to a single tranche. Another way to do that would be, and a lot of people ask is, why not just do this in the IWM? Because it's about 1/10 of the Russell 2000. And that's something that I have played around with as well. But, you got to be real careful with that because obviously, because it's only 1/10 of the Russell 2000, you're also only getting about 1/10 of the premium. And by doing that, but you're incurring the same amount of commission. So you got to be real watchful for, well, how much of a percent of these commissions are going to take more of a percentage of my possible profit, lowering my yields, because I still have to have a certain amount of contracts. I still have to have this single tranche ratio to have a single tranche Weirdor, but I'm not bringing in as much premium. So commissions and slippage make much more of a difference in that respect. And I think I just noticed something else that I was going to mention. It also isn't as very good. It's not as good of a tax benefit because you're getting taxed. You have a lower tax rate when you do trade index options as you do when you trade stock or ETF type options. But it doesn't mean that it can't make money using the IWM. It's just that you have to be aware of that particular those particular constraints. So, and again, I have traded them live like this and done some testing. My best results have been with a single tranche Weirdor in the Russell 2000. Of course, the SPX is also another. I'm just going to, for purposes of this, I'm just going to be showing the Russell 2000, but I have been playing around a little bit with the SPX, and I might be adding that in the future. But that's also, definitely a very good choice as far as indexes to choose for the Weirdor. But the IWM, really because of the just the lower amount of premium and the same amount of contracts, the percentage of those commissions are going to be a higher percentage of profit potential. So that's something that has to be watched out for, as well as slippage. So hopefully that answers a question that somebody else had sent me earlier. So those are the four main parts and the ratios. And the general guidelines are, again, like I said, you can use other indexes or stocks, but these particular guidelines are for the Russell 2000. And I like to start the trade somewhere between 40 and 55 days to expiration. So just, because we're basically there right now, I'm going to be starting the trade for this service probably either tomorrow or the next day. So sometime this week, most likely in the next day or two, you will start to see trade alerts going out for the entry of this trade. And I will warn you of that. So, and then all of the spreads. There's three spreads, and then there's one single. But all of the spreads are going to be 20 point wide in the Russell 2000. And then during the life of the trade, I'm going to do two types of adjustments. They're either going to happen because I'm doing an upside adjustment, the market's moving up, or the Russell 2000 is moving up, or downside adjustments. For upside adjustments, I don't defend the calls as much. And so generally, these are, if I start to move up too much, these are generally taken off for a small loss. Sometimes I roll them up, sometimes I don't. It really depends on what's going on. And as I said, this is not meant to be a intense workshop of every single scenario for, multiple months of the Weirdor. This is just a guideline. Those things will come as the trade alerts for every month happen, and as I go over each completed trade of what happened that particular month, those things will start to become more clear, but every month is different. Some of those, this is the type of trade where it's managed a little bit more on the Greeks, but also on what's happening with the trade at that time. I like to try to keep the T+0 line, fairly flat. I don't want to, I want to have some wiggle room to either side so that if as the Russell 2000 moves, I'm not taking a big loss whether it goes up too much or down too much. I like to keep that fairly flat, but I also don't want to over adjust and not have the ability to make money every month. So there's kind of a fine line there. And what I've noticed as my adjustments start to change a little bit depending on how many days I've already been in the trade. The longer I've been in it, I've got more wiggle room. So it does change it. So it's not something where I can just say, hey, every time we hit a 16 delta, I'm going to do this, or every time this gets to this, I'm going to, add another debit spread or something. It kind of starts out that way, but it starts to change over time. So, and those are things that you'll learn as each month, gives different challenges. Not to say that I won't have an in-depth workshop in the future, but this is more of a, since this is a trade alert service, I'm only going to be able to give those types of things as each month, as the trades happen each month, whatever the market gives me that month, that's what we're going to be learning. So downside adjustments are generally pretty easy. Those will happen, depending, and I will tell you, I'm going to be looking out for a certain level in the Russell 2000 to be adding put debit spreads, which is generally how I'm adjusting my downside to smooth out the deltas and keep my T+0 line, flat, not getting me in trouble. And if the market continues to move down, another type of adjustment I do on the downside is I may have to start beginning to remove put credit spreads. So that might be another type of trade that you guys see. And the exit strategy is generally I'd like to exit these 14 days to expiration, maybe 12 days to expiration at the most, but I don't really want to take these in too far. The last 2 weeks, there's really not much you can do as far as adjustments over the last 2 weeks, and I find that it's hard to, keep whatever profit I have in those last 2 weeks. And then I'd like to get on to the next trade with plenty of days to expiration left. So generally these are going to be taken off with 14 days to expiration. So that's kind of my general guideline. Now, for those of you that have subscribed or in the class page, in the Getting Started 2, Intro to the Weirdor Strategy, I also go through a sample of entering a Weirdor, so that gives a little more continuation onto that subject, so you guys can watch that as well. And that's actually shown in the analysis program, OptionNet Explorer. So what it looks like, and what it looks like graphically, and what I look at throughout the trade and so forth. So that'll give you a little bit more in-depth on that. So when you get a chance, please watch that video. So another thing I wanted to share with you, and I have seen some questions pop up. I know Tom's keeping track of those. I do want to get to as many of those as possible. I also want to share is what the trade alerts are going to look like. When you see a trade alert pop up, what's it going to look like? What to expect. So I'm going to just type in here real quick what kind of things you're going to see. So basically, it'll be Weirdor trade alert will be, I think, the first thing you see, so you know what it's about. And then most of the SMS and email text for the trade alerts are going to go out as actual trades that are happening. So I just got filled on something, boom, you guys get it out. Did I buy something, did I sell something, how many contracts, what were the strike prices, what was the price I got, and where was the Russell 2000 at that particular moment in time. Occasionally I will also send out, hey, I'm getting ready to enter a trade, watch out for trade alerts, or I'm kind of looking at this level in the Russell 2000 because that's what's going to trigger a possible adjustment or something like that. So those are types of things that you'll see. But what I want to make sure you understand is what these trade alerts will look like for the actual trades that are happening. So they're going to look something like this. So let's say I sell something. So it would look like sold plus, or I should say minus, how many contracts. So let's say this was the put credit spread I was getting into. So it would be something like sold minus 10. So that's the number of contracts. Vertical. And I believe it says RUT. I think it says RUT, I'm pretty sure. And then it would be the contract month, so let's say March 15. So and these are going to be the monthly expiration cycles, so they won't be throwing any weeklies in there. And then the strike prices. So let's say it was I'm just going to make this up, the 1070, 1050, again 20-point wide. So if this is a credit spread, I sold the 1070s and bought the 1050s, and you can see that it's obviously a credit spread because it says it's sold -10, so 10 of these verticals in the March contract, the 1070s, 1050, and then the price So let's say I sold them for $1.90. You would see something like add $1.90. And then it'll either say mark or last equals, let's say 1181 or whatever the Russell's at. I think it's a 75 right now. So that will be where the index is at. So it'll either say mark or last equals whatever the Russell 2000 index is at. So that's how you'll read that. You know, sold something, how many contracts, was it a vertical or a single, in what month for the Russell, what expiration cycle, what strike prices, what I filled, what the index is at.
Amy,
Yep.
would also say whether it's puts, whether it is calls or puts. That's the only
Oh,
thing.
I'm sorry. You're right. Yep. Put. I forgot that part. I apologize. Thank you for letting me know that it will include that. Another thing you'll see is maybe I'm buying the debit spread. So it would be something like bought plus one vertical rut March 15, let's say 1160, 1140, puts at say $6.60. Last would be very similar because these are going off, if this is an entry trade, very similar timing. So maybe it's 1175 or maybe it's 1176 now or something like that. And then this might say bought like that, or it might say bought like I spell it out. But that would mean the same thing. So that's what the makeup of the trade alert would be. So you would get something like that. It would just say Weirdor trade alert, and then you would see what I sold or what I bought, how many contracts, what expiration month, what were the strikes, puts or calls, the price that I got, and where the index was at that particular moment when that triggered off. And those will go out to you as soon as they get filled. So there'll be a delay, but it's not going to be very long. It's not going to be like, more than 30 seconds or a minute at the most or something like that. So it's not going to be a long delay. Hopefully within the next, within 15, 30 seconds or something like that. So, so that's what the trades will look like. And again, as I said, when to expect them, I'm looking to start the entry of the March 2015 expiration cycle, like probably tomorrow or Wednesday. So you should start to see some trade alerts appear on your in your email and in your for text messages, as well as they will once those are triggered, they will show up in the trade alert tab that will appear here as well. So I think I answered the questions that I received online. I believe I answered all of this. So if there's any other questions, I know Tom has kind of been keeping track, and we can kind of wrap this up. And
yeah,
again,
we had quite a few, actually. One of them is, are you going to provide the fill prices, like for each leg, like maybe either in a trade image or in a summary, like on your video, so people can actually put in the actual prices for each leg?
I will provide that in the weekly recap.
Okay, great.
So, okay.
And then Jack asked, are these alerts only going to be sent out after you get filled, or will you provide alerts when you enter orders?
I will provide alerts to kind of give an idea of when I'm going to get ready to do something. Like, for instance, I'm getting ready to enter a new position, or I might do something like, I'm kind of looking, sometimes I might do something where, I don't know, maybe 1150 is a trigger point where I'm going to be looking at possibly doing an adjustment on the put side, just to give it like a, keep that in the back of your mind. It may get triggered, it may not, but I might do that kind of thing. But I'm not going to do, I'm only going to, as far as the actual orders, I'm not going to do separate trade alerts for placing the order and for filling the order. I'm just going to do one if it's filled, because sometimes what will happen is I'll be looking at a specific strike to try to fill it, and it doesn't get filled, the market moves a little bit, and then I have to kind of adjust my whole trade over, and then all of a sudden I'm getting filled on different strikes, and I think that would be a little confusing. So I'm just going to just send out when something gets filled, and but have a little bit of a heads up. Hey, I'm getting ready to enter a trade.
Okay, and then Rick asks on the order of entry, do you look for a pop in volatility and then go with the put credit first during like 40 or 55 DTE?
I prefer to enter these trades on a down move. And I do have a kind of an order of how I like to enter these. As I do like to put in the put credit spread first. And yeah, I do, start to look for a vol pop and a down move to enter these, although it's not a requirement. And I do talk about that in a little more detail in, again, the Getting Started 2 video. So I'll go over that. I go over that in a little detail in there and kind of how what types of trades to see first. But basically, I like to do the credit spread first, make sure that because that's where most of my money is coming from. I want to make sure that gets filled at a price that makes the rest of my strike prices that I chose make sense. So I always put that in first, and then I start, then I usually go from that to the debit spread, the put debit spread, and into the call credit spread and the put single, but those last three can come in any order. The put credit spread I want to get in first, and then I start getting, start putting in my orders for the other ones, and they just kind of fill as they fill. But I always want to make sure I get filled on my put credit spread first before I start putting in the other orders.
And then Bill Burton, hi Bill, said, do you trade these in a PM account as well? If so, are there significant differences in the return?
There are some differences in the return. Well, I mean, it depends on how you calculate the return. There are some differences because of the way I trade it in a PM account. Not so much if I traded it the same way, and I still calculated return based on maximum risk and not on like my portfolio margin, the returns would be the same. But because I have more margin to work with, I tend to add an additional credit spread. And I also manage some margin with some weeklies. I can do some different things in a portfolio margin, so it kind of makes things a little bit different because of those reasons, not because of, if I just traded basically exactly the same way, it would be the same. It would just be, you just have more margin to use. But because the portfolio margin account allows me to do different things, I trade it a little bit differently in a portfolio margin account, but it has similar results.
And Rick said he followed your webinar the last time when you were putting on your Feb trade, and he thinks you're up around 7%. Is that about right?
I'm almost there, yeah. I'm actually, up about 7%. I think I'm up about 5% right now. It's about 5% right now.
Okay.
I'll have to check that out, but I'm looking to get out that trade on Friday. So, or maybe I'll be able to get out of it a little bit earlier. If it gives it to me a little earlier, I'm not interested in sticking around and seeing what happens. So there are occasions, though, and it's only happened to me, well, it happened to me twice, but only worked out really well once, where I was able to stay in the trade a little longer because it was just in the sweet spot. Whether it moved up or down, it kind of didn't really change the amount of money that I was up. It gave me a little bit of wiggle room while I kept collecting additional theta. And of course, as the gamma starts to take effect, but volatility starts to lose its punch the closer to expiration you get. So it's just like I've been able to take these into like a week till expiration. I don't really recommend it. It worked out really great for me once, and then it took out some profit that I had already collected another time. So it's just kind of like a nail biter if you want to wait longer, and it only occasionally gives you the option to even do that because it just happens to be in a certain sweet spot. And if it happens to be that way on a particular month, I will definitely talk about it then. But I prefer to get out when I can. So.
And Martell asks, what's the difference between Dan Harvey's Weirdor, yours, and maybe even the Jeep?
I'm not as familiar with the Jeep Weirdor. I think the tranches the ratios are a little bit different, and I think the adjustments are different too. I know, Jim, you're there. You probably have a better idea of what the differences are on the Jeep. I looked at it a couple times, but it's been a while. So I think the last time I took a look at it was probably about 10 months ago or something. And I do remember it was different. I think the adjustments are a little bit different. I believe you take off, as the market moves down, you take off credit spreads instead, and the ratio of the different pieces is a little bit different as well. As far as Dan Harvey's, it's very similar, but Dan Harvey, he actually sometimes will do a little more manipulation as far as like sometimes he'll throw in a butterfly, make adjustments with butterflies or back ratios, things like that. Makes it a little bit more complicated than my liking. And I don't like to, he doesn't like to sit in front of the computer either. He's pretty busy doing lots of fun things as well. But I just found for my personal taste, I tried to take his and instead of, it already has enough trading choices, I think. And so I tried to limit the types of trading choices that I had as far as those things. And I didn't want to, I think sometimes by adding a lot of those butterflies and different things, it wouldn't necessarily happen every month, but some months, and trying to collect a little bit more credit, adding some more credit spreads as the market kind of moves around, just adds so many pieces that by the time it gets to the point of taking it off or maybe having to make there's a big move and having to make another adjustment, there's so many different parts to try to remove that trying to keep track of all that slippage and still remain profitable was a little bit too much for me, just for my liking. So I tried to how can I make this, it's already more complicated than my nested iron condor, how can I make it as simple as possible for my liking? So I guess that would be the differences there. So I'm trying to stick with more simple adjustments.
And Jack asked, he understands you're not going to send out an alert for all orders entered, but are you going to provide a detail in the weekly recaps of how your orders were placed and adjusted prior to being filled? He finds learning the execution thought process is also very important in learning these trades, so would hope to see more detail on this as well.
Yeah, and I think that's also going to be covered in the WebExes upon completion. It's kind of like, and with the weekly recaps. I'm going to be, keeping track of notes of, what was my thinking when I put that on. And in a lot of cases, it might be just very simple that, I got filled pretty quickly on the strikes that I liked, but in other cases, if something happened where, hey, I was really looking to do these strikes, but then all of a sudden the market did this, and I had to readjust my whole position, and I will talk about that kind of stuff. So, I try to go over as much as possible so that my thought process is kind of getting out there. But again, there might not be, sometimes there might be more than others. It's not, super, super complicated. So a lot of times these get triggered pretty quickly, especially on a single tranche. So I'm not having to do a lot of that stuff. But if there is anything like that, I definitely will be covering it, especially in the weekly recaps. I want to make sure that information is out there as soon as possible for learning purposes as the trade kind of progresses. So.
And Randy said, is there trade entry based on anything besides days to expiration? Why is there a range? I know you already talked about you like to enter on down days.
That's why there's a range, and part of it is I want to make sure that I'm not in the trade, the previous month is already closed. Okay, how many days I have left? At that point, like for instance, February is a very short month, so I'm already 45 days to expiration on the March trade, and since this is the first trade for the class, I'm going to go ahead and put it on. But, I might wait until Friday for, for purposes of making it, the same strike prices as I would get or look for in my live trading. So, it's kind of like I don't really want to enter it with less than 40, for the very first one I do, I don't really want to enter it with less than 40 days because I want to make sure I get enough premium. So I think that, somewhere between 40 and 55 days is a good sweet spot. And I might start looking at it at 55 days if I'm, already knowing that I'm going to be getting out of the other trade and kind of wait for that trade to be over and then kind of wait hopefully for a down move or just kind of see what's going on. Is there a potential down move coming? But I'm not going to necessarily say I'm not going to just keep waiting every single day until there's a big down move either. So that's just, I think that 40 to 55 days is a good sweet spot. Most of these that I've been putting on that I found the best results in have been done at about 45, somewhere between 45 and 50 days. A lot of it is about 45 days. And getting out either the Friday, with 14 days expiration or the following Monday at the latest. And those have been the best, those have been my best trades. So it just worked out that way. So.
And Phil ask, do you have rough margin requirements for one tranche in Reg T and PM?
For Reg T, it's 20. I'd like, as I'm going to emulate this, it's just if I'm doing a single tranche Weirdor the way I set it up, the ratio that I had showed earlier, I would want to have a $20,000 account. The $18,000 is probably, it's going to be about 18,000, somewhere around there, as far as what margin is actually going to be used because of the amount of spreads that I'm doing on the credit side and the amount of premium I'm taking in. So it'll balance all out to, and then of course the debit spreads and so forth. It'll balance out to about $18,000 margin for a Reg T account. And I like to have that $2,000 cushion because especially when, start off, it's like, hey, maybe the first month's a losing month. You never know. It could be that works out that way, even though it's a high probability trade, depending on which month you start with, hopefully it's a winning month, but you want to leave a cushion. And so I'll, for this particular trade, because it's not like an iron condor where my margin could be changing quite a bit, it basically stays the same as I'm doing adjustments. It's very similar. So I know that I have a little bit of cushion there from the beginning of this trade. As far as portfolio margin, of course, the margin is going to be a lot less, but you just deal with margin differently. And even in a portfolio margin account, I still look at what my max risk is because I want to know, where I'm at. I'm just able to margin up more if I need to. And as I said earlier, I trade those a little bit differently. I put on an additional credit spread, and I do, because the margin does change more in a portfolio margin account. Let's say I margin up quite a bit. My margin will change as I get closer to expiration. My margin, it might go up, especially if the market's going down. I might have a higher margin than what I started out with, and sometimes I'll deal with that by buying some weeklies. Out of the money weeklies just to make sure, like with 2 weeks to expiration, so I know that I can get through the trade, and that deals with that. So it's a little bit different with portfolio margin, and I'm thinking about, I can add that on too, but for right now, I'd get started, start this thing off simple, so you guys can learn what I'm doing with the Weirdor trade. I think it's best to remove some of those nuances and concentrate on the basics because that's a really good building block for how this trade works and understanding it no matter what type of account it's traded in. So.
And Martel asked, what happened on the month that you lost 7%?
Oh, I got a little cocky. I was pushing it a little too far, and I had an order that triggered. It was a conditional order, conditional order that triggered. And I heard the little bleep, in Thinkorswim, it kind of gives you a little alert, and it went off. And I thought everything was filled. Of course, these are multi-tranche, so there's more than just one contract. Or this was a put debit spread that was supposed to fill, actually. And unknown to me, I didn't look. I, was kind of lazy, I guess. It didn't. The complete order didn't fill. I think I was looking to buy about 20 put debit spreads to correct my position. We had a big down move. I had already made some adjustments already. And it only filled like one or two. I think it was just one, actually. And I was just thinking, oh, it filled the whole order. And it didn't. And I went away and, went off and did my own thing. And all of a sudden, by the time I realized what was going on, it was too late to, the market had moved way beyond the point of my adjustment. And I was looking at a much larger loss than should have been. So I keep an eye on them a little bit more now, a lot more now. I make sure, even though I have a little bit of a move, I'm not trying to get these things filled at, like especially on a contingent order, I'm not trying to get these things filled at the mid price. I'm definitely giving it, whatever, 20 cents, 15 cents at least, something like that, to make sure it gets filled. This one was just happened to get triggered when it was a kind of a big shift down, and it filled one and didn't fill the rest. So that's kind of what happened there. And I just decided try to, fix the trade as best as possible. And I did what I could, and I finally just took it off at that bigger loss. So it was definitely a lesson learned, and that happened. So
yep.
That was that. So most of the time, this is supposed to be a trade where the losses are less than the gains that you're trying to make, as opposed to an iron condor, where, like my nested iron condor, I'm willing to give it a max loss of 1.5%, sometimes even, or 1.5%, 1.5 times what I'm trying to make. And occasionally even 2 times what I'm trying to make, depending on what's going on, and knowing that, over time, if throughout a year, I might only have 1 or 2 of those that actually hit a max loss, and I'm going to make a profit at the end of the year. With the Weirdor trade, it's supposed to be a lot smoother to where, and you talked about this earlier, that that profit line going up, the return line should be a lot smoother, and that's the reason why, is because I'm trying to keep these things where I'm making, keep collecting data and making money, but trying to keep the losses even smaller than what I'm trying to make every month, to kind of smooth that out and make it a little easier, profit potential, or I should say, what did you call that graph, Tom? The
equity growth curve.
return on investment, just your return a little bit smoother. So that one was a lesson, but generally, this particular trade should be, the losses should certainly not be more than 1 time what you're trying to make in a month, or that's what I try to keep it to. But I don't have like a max loss where I'm getting out. It's more of managing the trade, and it just ends up to be that way as it's being managed. It just tends to deal with losses a lot better.
And Bill Burton asked, as the service gets more of the basics covered, he'd love to see the nuances in portfolio margin. And maybe, I'm guessing you could probably address those in some of those weekly videos, or maybe even the live WebEx one you do after each trade's closed.
I think for now, just because this is starting anew, and I want to, make sure that I'm covering all the bases with what I'm sending out, I think I'm just going to concentrate on just the Reg T account for now. And as time goes on, and I'll start thinking about maybe adding SPX, maybe doing a portfolio margin one, but that would come in the future. So I'm just going to, but for now, I just want to make sure I get this done right. So I'm just going to concentrate on the Reg T account for now. And if somebody has a portfolio margin account, or they want to see what it looks like in a portfolio margin account, following along, maybe with maybe multiple tranches, or scale it up, or see how it is affected, would be still a good learning experience, and certainly something that as with anything new, always recommend trying it out in paper trade as opposed to live. But I'm sure there's quite a few people here that are quite experienced traders, so it's not me. I'm here as more for educational purposes, so I can't recommend anything as far as a live account is concerned. So, but like I said, it should work the same whether you have a Reg T or whether it's done in a Reg T account or whether it's done in a portfolio margin account. The mechanics would work very, very much the same, and can be followed with what I'm going to be sending out. So.
And Russ asked, how timely does one have to be to execute your signal? So if they get a signal and they want to try and mimic it in the market or paper trading, how time sensitive do you think it is?
Well, I guess it just depends on what's going on in the market that day. For paper trading, like if you're doing like let's say you have a real-time paper trader like Thinkorswim, which is definitely real-time, if the market's really moving, it could make a difference. If it's the end of the week, the end of the day or the end of the week is going to make a difference because a lot of the data comes out. Let's say I did something in the morning, and then all of a sudden, you want to try to, I look at those same strikes in the afternoon. They might be, even though the market might be in the same spot or close to the same spot, the premium might be different. So sometimes I can't say for sure when it's going to be, it just depends on when they're executed. Sometimes it'll make a difference, and sometimes it won't make that much of a difference. I wouldn't say that it's so time sensitive that it has to be within 5 minutes or something. I'm sure there could be some more wiggle room. But it's kind of, like I said, obviously if there's an analysis program that you're using, like a back trader like OptionView or OptionNet Explorer, you have the capability of going back in time and putting in the exact prices and so forth. And I think you can actually do that in Thinkorswim back trader, but I'm not as familiar with Thinkorswim back trader. I'm only familiar with their real-time paper trading account. So I'm hoping that they're not too time sensitive, but I'm just going to be able to, what I'm going to do is give them to you guys as soon as I get them. So I guess we'll kind of learn that together. But like I said, I think in some cases they'll be more time sensitive than others for various reasons, like either the market's moving a lot or it's the end of the week and the morning to the afternoon. might make a difference even if the Russell 2000 is, very much at the same price just because of theta decay over the weekend. So those would be the two main reasons I think that there might be some time sensitivity.
Okay. Andrew asked, how does this trade perform during a prolonged bear market?
I've only back tested it. I'd have to go back through my back testing. I don't want to just give you false information. So far, in all the back testing that I've done, obviously the forward testing, the actual real live trading that I've done has not been in a prolonged bear market. I've only back tested it in different periods, and I found that it can handle pretty much most market movements fairly well as long as it's managed, as things are happening. Obviously, if it was like, in a prolonged bear market, as long as it's not, the only time that it would cause problems is, and this doesn't really happen very often, is generally, even if there's a prolonged bear market, there's ups and downs with the market movements. There's not just constantly going down, as opposed to in a bull market, it tends to just kind of go up, and up and up and up and up. In bear markets, there tends to be some choppiness. You get more volatility, you get further away from the market. So there's opportunity to still, be safe in a trade like this. Whereas the times, like if you're talking about a bear, like a bear event, where there's some big event that makes a big market move down, like a big correction, they're usually short-lived, and that may be a losing month, but they usually don't go prolonged for month after month after month after month. Even if it's a bear market, there's a 10% drop, and then another 10% drop, and then another 10%. We might have a big correction, and then it kind of goes up a little, and then down a little, and a little, and down a little, and over the year maybe it's a little bit lower. So that should affect. The only time I can think of where there was something that was like 10% down and 10% down was during the end of 2008 and 2009. That whole year was just unprecedented. I mean, we had never gone through that. And I think it had more to do with nobody knew what was happening. Nobody had ever been in that kind of situation before with the banks, and nobody knew what to expect. And when there's that type of uncertainty for that prolonged period of time is what caused that. But I can't imagine that kind of unprecedented movement happening again. Not that it can. So I would say in just a regular bear market, it should perform fairly well, but it might not perform well on those months where there's a big correction.
Amy, I think that you hit the nail on the head. We traded this through 2011 when we had that really horrible, summer, fall with the whole debt crisis. We only back tested through 2008, and it is two separate markets, as you ended up pointing out. When the market drops significantly, what ends up happening is that those extra puts that you buy explode in value because the implied volatility goes up and you become long Vega. So if you blow out the bottom side of, and this is why we started calling it the Jeep, right? If you blow out the bottom side or the back of the Jeep or the downside of the the condor structure or Weirdor structure, the additional puts will end up offsetting a lot of your what ends up happening is that when the vol goes up, it doesn't go up evenly across all strikes. What tends to end up happening in lower vol environments, the very far below the money implied volatilities have a much higher ratio compared to the options at the money, whereas after you have the market, issue or events that end up taking it down, the implied volatilities tend to be closer. They're all much, much higher, but there isn't quite the same percentage difference between the below the money and above and at the money. And that's where the Jeep ended up changing a little bit, because when the vols end up going up extremely high and the vol skews get flatter, in those months, in those bear situations, We didn't buy the additional puts at that point because they were just way, way too expensive. We ended up adjusting our ratios of how many put debit spreads to put credit spreads we were putting on, and the flatter vol skews ended up playing that nicely. So the answer to his question is basically it works extremely well, okay, over time. Yes, you're going to have losing months when you end up running, out the back, or you have to end up making too many adjustments. But what tends to end up happening is that when the implied volatility goes much higher, it also means that your whole spread is much, much wider. And so therefore you can tolerate, later in the bear cycle, you can tolerate much bigger moves. And that was the whole beauty of the Weirdor and Iron and the Jeep. And when Dan Harvey and I talked about, when he ended up first showing it to me and we ended up going back and forth, these were the scenarios that we ended up playing through.
Thanks, Jim. We're almost out of questions, just a couple to go. Jack says, so you use contingent orders for a safety net, and I think that's a yes.
Yes.
Okay, and then Rick asks, if we learn this strategy, can we apply it to NDX and SPX?
Well, it would be a little bit different in the SPX and the NDX because the strike, like for instance, for the SPX trade, 25-point strikes would probably be better suited there. Not that a 20-point strike would be further, wouldn't be applicable, but would just be a little bit different. This is definitely the ratios that I'm using, and all the way I'm setting it up is definitely for the Russell 2000. It would be similar for the SPX, but the NDX would be, I think, further a little bit, further more different than, I guess, comparing the SPX and the Russell would be more similar than the Russell and the NDX, because the NDX, it definitely moves a little bit differently and a lot more violently, whether it's up or down, and the strike width might be quite a bit different, maybe like a 50-point strike width as opposed to 25. So, that changes the margin, it changes the ratios that you might want to use. So, I'm like I said, I'm just sticking with the for this particular class for now, just the Russell 2000, and that's the one that I've mostly traded. I haven't really, I've done a little bit of testing with the NDX and traded a little bit with the SPX, and I might be, I do like the SPX version of it, and I might include that as well in the future, but I wouldn't say it's like a one-to-one comparison, like whatever my adjustments are on the Russell, you can do something exactly similar in the SPX. It would be a little bit different.
Amy, Stephen, Chad, and I did a lot of back testing on all the indexes, and our findings were exactly what you just said.
Everything has, and the other thing about that is, everybody has a preferred trading style. You tend to have preferred strategies that you like, and you get used to certain indexes or stocks, and you get a feel for how they move. And that also plays into that as well. So whereas, one person might like the way the Russell moves and have a really good understanding of it, another person has a much better understanding of the SPX or the NDX, or can deal with all three of them. So that really takes into play as well. And that's you only garner that kind of knowledge as, as you trade in these different environments and different strategies and different indexes over a long period of time with your own experiences. It's just I think it's a kind of a personal thing.
And last thing was really a comment, says drop in vol helps us trade because it is short Vega. And then we have lots of thanks, Amy, excellent job. So thanks everyone for the good feedback.
Thank you very much. I look forward to sending out some trade alerts this week to everyone, and I hope that is beneficial and you guys learn a lot and you enjoy the class. And any comments or suggestions, because this is new, I'd love to hear anything you guys have to say. I really appreciate it, and I like I said, I look forward to getting this thing rolling and you guys learning stuff.
Thanks much, and thanks everyone for sticking with us so long. We really appreciate it, and hope you give Amy's signals a try. There's 15 days for free. And thanks, Jim, for joining us too.
Amy,
Thanks
thank
a
you
lot,
so
Jim.
much.
Thanks, Tom. Thanks, Jim. We'll talk to you soon.
Yeah, and Rick, yes, you can log into the site during the test period. So thanks, everyone.
Thanks. Bye.
Bye.